Hello everyone, welcome to the latest episode of Meet the Investor. Today we have Luke Cummings joining us, Chief Investment Officer and founder of Harvest Lane Asset Management, a fund manager specialising in merger arbitrage and currently looking after a little bit more than 200 million Australian dollars within Australia and globally. Thank you for joining us today, Luke.
Great, Joe. Thanks for having me.
Luke, it'd be great to start with a little bit of background to yourself and the fund, what got you into the space and what the fund does.
I grew up in country New South Wales, not from a family that had any background in markets or really any investments at all that I was aware of. I sort of fell into my first job in funds management when I moved to Sydney, and I just thought the whole thing was fascinating. This sort of process of uncovering things that other people hadn't seen. When you're at university, you obviously learn about efficient market hypothesis. No one's supposed to have any information or insight that is beneficial beyond what everyone else has. And I think the more you kind of are involved in markets, and certainly in some of the sort of esoteric places we're looking, you just realise there's these huge inefficiencies that exist for a bunch of different reasons. I think the other thing that I was sort of captivated by was lots of people make money in equity markets when markets go up, and lots of people lose money, at least notionally, when the equity markets go down. And as you know, there's a whole subset of investors that doesn't work very well for, from a sequencing risk perspective and income and all of those things that go with that. And this strategy really struck us as something that you could use to make equity market-like returns just without full equity market risk and volatility. And that was sort of the genesis of how we ended up doing what we're doing.
Great, and can you go a little bit into, I mentioned merger arbitrage in the introduction. What does that mean? What does the strategy do?
Yeah, sure. So I guess merger arbitrage in its most basic form is you're betting on an announced merger or takeover closing. So I'm sure we'll get to some examples of that later on, but in its most pure form, company A says they're going to buy company B, it's at a certain price, and it's going to close at a particular date in the future, and there'll be usually some preconditions that need to happen for the deal to close. So maybe it needs regulatory approval, nearly always needs shareholder approval, it may be subject to funding, it may be subject to due diligence, there could be a bunch of different things that dictate whether or not the merger or the takeover will close. And what we're really trying to do is figure out, when those deals are announced, what is the likelihood that they close in their current form? What is the possibility that the terms are improved? And what's the likelihood that the transaction doesn't proceed? So a return element or return aspect of that is that it's time value of money, I guess. If you're expecting to get $1 in 3 months' time, then clearly that's not worth $1 today. So that accounts for part of the return profile. But I guess a larger part of the return profile is, is the merger going to close or not? Are the terms going to be changed? And really our process is aimed at being very certain that the merger will close in its current form, and every now and then hoping the terms get improved. I'm sure we'll get more into the process of how that works, but that's a pretty, I would say, unusual strategy in Australia. Pretty well, sort of worn path for hedge funds offshore in the US and Europe. We don't really have a direct lookalike competitor in the Aussie market. Been going for about 13 years now, I guess, and I'd say we're still pretty under the radar in terms of how many people know about us.
So just unpicking a little bit of how the strategy works, when a takeover is announced, the price at which the bid is made isn't necessarily reflected in the stock price immediately because there's a chance that it won't go ahead. Is that right?
Yeah, absolutely. So part of it is the time value of money aspect we talked about, but part of it is, that's exactly right. So at that point in time, everyone has to make a judgment about, is this takeover or merger going to close, or is it not? So a really high profile example of that from a few years back is, I guess everyone remembers when Elon Musk was talking about buying Twitter, and then he wasn't going to buy Twitter, now known as X. And I think when I talk to people about merger arbitrage and what we're doing, that's probably the most high profile example that people can think of. So there was a lot of talk about Elon isn't going to buy it. He was talking himself about not buying it. He was telling people he didn't have the money to buy it. But if you sort of understood the landscape of how these things work. There was a whole bunch of documents he needed to release to the SEC. Obviously, it was a US-driven process, not an Australian-driven process, but a lot of those documents upfront need to basically specify that he has funding, what the conditions are for closing, etc. And I would say for anyone with a reasonable amount of merger arbitrage experience, it was really clear that the likelihood of him getting out of that deal at the time was very, very low. So I guess that's the most high-profile example that people would think of. And look, I guess like anything, once you have some experience, you can sort of figure out what the key things are that you need to focus on that, will kind of dictate whether a deal is going to close or not. Plus you have people, part of it is needing to work out whether the deal is going to close, but sometimes people sell because they're a small or mid-cap manager who now is happy to have liquidity because the stock that they own has just attracted a bid. Maybe they don't know how to assess whether the deal is going to close or not, so they're happy to have liquidity for that reason. Maybe it's a retail shareholder who has owned this stock for 4 years and all of a sudden it's up 30 or 40% a day. They're happy to sell it and move on. So I kind of think of us as being somewhat of a liquidity provider, in addition to, I guess actually trying to work out whether or not these deals are going to close.
Yeah, that makes sense. So when you place one of these trades, do you have to get each one of them right, or do you have a particular hit rate in mind?
I'd like to get them all right. We definitely don't. I think our average hit rate's about 80% in terms of the success. And success is defined, I guess, broadly as being profitable. Some of them are more profitable than others. Clearly the same for losing trades. So some trades are a very small loss. Others can be larger at times. But the edge is just the repeatability of being able to have a fixed number of transactions. Every year we would typically do sort of 50 of them, give or take. Every year we would participate in, and I guess it's the old Buffettism of rule A, don't lose money, and rule B, refer to rule A. We're really trying to focus on how certain are we that we're not going to lose capital in each of these situations. We both know markets are hard to predict, so things happen, but if we deploy capital and kind of manage, I guess, our bankroll, if you like, to use poker parlance, the edge sort of exists and will take care of itself. So you definitely do not need to win every time, but trying to make sure we win as often as possible, it's helpful.
And we'll go into some examples a little bit later, but you mentioned there obviously not everything can go right, and some things are out of your control through that process. You talked about the Twitter example. How do you manage things when things start to go wrong and you have to maybe reassess your thesis? What's your process behind that?
Yeah, good question. So I think every single one of our positions, or even things that aren't yet a position but we're kind of monitoring because it might be, we are very dynamically managing those opportunities. So this is definitely not a set and forget strategy. Obviously passive is a huge thing globally in terms of how many people are investing their money in equity markets. If you just bought this strategy as a passive strategy, buy every deal, wait for it to close or not. There are US ETFs that do that, and they haven't done particularly well over the past 10 years. So I think the thing for us is that just having that flexibility around not being too wedded to any given position, not being too wedded to a thought process. I think it's that whole comment about when the facts change, I change my mind. So our view is, as I mentioned before, we have sort of 50 odd opportunities a year. You don't need every one of those to be a success. What you need to do is make sure that none of those become such a big loss because you get so wedded to I guess a certain way of thinking about it that it has flow-on consequences. So I think our thing is we have a view, we have a really extensive checklist process. 13 years ago we would have had half a page of checklist items. Now we've got 4.5 pages of checklist items. Happy to talk through what some of those things are, but I think it's just being really clear on we have done close to 1,000 transactions over the past 13 years or so. We've got a pretty good feel for when something's going to work or when it isn't. So I think the key there is not too wedded to one position. Not every single one of them needs to make money. If you start to get the feeling that things aren't going to work out the way you thought they were, you should cut it and move on as a general rule.
And you talked about that you're focused in Australia. Is there a particular part of the Australian spectrum you're focused on? Do you do the sort of larger end of town? We've seen BlueScope in the news recently, being the target of a takeover. Is that the sort of thing you've been involved in?
Yeah, we have really broad mandates. So, sort of market cap band you mentioned before, we're managing, a little over $200 million, which is not a lot, compared to what a lot of fund managers would run. But that's a nice number because it gives us the flexibility to move up and down the market cap bands. We definitely would look at something like BlueScope. We're not currently in BlueScope. One of the things we like in deals generally is something that's binding, because as soon as something is binding, it's legally enforceable. BlueScope's approach is not yet at the binding stage, which means that there's no impetus for the bidders to have to proceed. It's easy for them to walk away. It's easy for them to change the price, etc. So definitely watching it. What we find in Australia is at the larger end of the market cap spectrum, so your BlueScopes of the world and your Cube, and we've obviously had approaches recently for Santos, was pretty topical last year. The bigger things tend to be riskier from a regulatory perspective. So things like ACCC and FIRB can be hard to handicap, especially for big things and sort of companies or stocks that are kind of national champions or big constituents in our indexes. So that doesn't tend to be a happy hunting ground. You can also have offshore funds. I mentioned before we don't have we don't really have any Australian based competitors, but the big offshore funds can definitely do bigger things. Our sweet spot tends to be small and mid caps that are kind of under-owned from an institutional perspective, very retail heavy bases in terms of the shareholders, probably aren't using tier one advisors in terms of bankers and lawyers and the like. So we are very broad, but really anywhere that we can deploy capital where we feel that the kind of risk asymmetry is in our favour.
Well, with that smaller end of town, how do you get the information required? How are you able to do the amount of research I imagine you need to do to make an appropriate decision? Not as publicised or large companies.
Look, lots of people, I guess, are talking about AI at the moment, and rightly so. We have a pretty small team by most fund manager standards, and I think it became really clear to us from day one that we needed technology to aid us in the process of filtering and monitoring a lot of these opportunities. So, if you imagine having to read through every single ASX announcement, every news item in the Australian Financial Review, the Australian, whatever it may be, that takes a lot of manpower, and you would just inevitably miss things. So we have always had a lot of tech, and we've continued to invest in that tech stack that's customized. We built it internally just to search for keywords, certain phrases, really organised around detail of a lot of these transactions will have certain key dates or markers or milestones that we need to adhere to. So really just trying to be efficient in terms of being able to filter for lots and lots of opportunities, to identify new opportunities, to be able to really efficiently monitor the stocks that we have already. You can, I guess the benefit of being in Australia is 13 years odd at Harvest Lane, and let's call it 13 years before that in various roles. You get to know the stocks, you get to know the directors, you get to know the bankers, you get to know the lawyers. So kind of trying to form a pretty good picture initially of what might this individual company be worth, who else might be interested in buying it, are the shareholders who are on the register currently likely to be in favour of a deal, are they likely to be opposed to it, who's a counter bidder, what other transactions have happened in the space. We've probably participated, as I said, in 50 or 60 deals a year for 13 years at Harvest Lane, probably got another 13 years of experience before that, and then a whole database of deals that we haven't participated in, but we've kept records because we need to be able to, or want to be able to refer back to them. So getting information isn't easy, but it's maybe not as difficult as it might seem just by virtue of the processes that we have in place.
And so let's get a bit deeper on that with a tangible example of maybe something that's gone particularly well for you in the last couple of years.
Yeah, I guess a trade that was sort of at the latter part of last year, PointsBet, which is still actually an ASX listed company, which is unusual for a stock that's been through a takeover, but they received a bid from a Japanese buyer, Mixi, $1.06 per share was the initial bid price. It's kind of probably around March, April last year. And over the course of the next 6 or 7 months, that became a contested situation. So locally listed Better also made an approach, and through a sort of series of escalations, having started at $6, we ultimately realised $1.40 of value at the end of that takeover process. As I mentioned, unusually that stock's still listed because there was no clear winner at the end of that. But from our perspective, the bid at $6, Japanese bidders are notoriously good bidders in the sense that they tend to do what they say they will do. They often come with cash bids. They're often pretty fully priced. So you kind of risk of the big risk in this strategy is always that the deal that you're assuming is going to happen doesn't happen. And our whole process is aimed at trying to make sure that becomes very, very unlikely. PointsBet was just this nice situation of having two parties that really wanted to ultimately own the company, and over a series of months we were able to build the size of our position to where it became quite large, but because of the deal structure it was actually less risky towards the end than it would have been on day one, and it was certainly one of our better trades of the year. We're typically looking to buy something for 96 or 97 cents and realising $1. So that's the sort of bread and butter of our strategy. If we're talking baseball parlance, we're hitting singles and doubles, not home runs a lot of the time, but every now and then you do get a home run, which I guess is what PointsBet was. And we don't know going into these trades which ones are going to turn out to be like PointsBet. If we take care of the downside, then the upside tends to take care of itself.
And so far we've been talking a lot about sort of the core of your strategy, which is the majority of the trades that you do, but you do have a slightly different approach when an opportunity comes up. Do you have an example that could sort of shed light on?
Yeah, for sure. So we're generally looking for kind of asymmetric risk, I think, and where we can sort of quantify downside and be pretty certain about not losing money. So another type of trade that kind of lends itself to that is we've had a lot of success with like liquidations or wind-ups where an ASX company, often property related in fact, will say, look, we've got this listed REIT, it's not trading at NTA, and we're going to liquidate the assets and wind it up. We don't speculate on things that might happen, so we're looking for what we would call a hard catalyst, as in it needs to be announced and pretty certain it's proceeding. Very topical one last year, I guess, was Global Data Centres, GDC. I would say most listeners have never heard of that stock, but they've certainly heard of one of the underlying investments, which was AirTrunk. So AirTrunk was sort of in the news daily for a period of time. It was a co-investment with Macquarie, ultimately purchased by Blackstone for multiples of what Macquarie had paid to invest in AirTrunk a few years earlier. What attracted our interest was not AirTrunk per se, it was the fact that the stock was trading at a very big discount to stated NTA. They had managed to sell one of their data centre assets for a premium to its book value, which is usually a good indication that maybe they can do that with some of the other assets. The jewel in the crown really that I think not many people realised at the outset, including us, was AirTrunk, which obviously data centres and AI have become very big thematic from a market perspective. We would have started buying that stock at roughly $1.30, $1.35. I think we realised ultimate proceeds of $3.55. That's a pretty unusual trade for us, as in it's not the bulk of what we do. But that was really interesting because the more assets they were selling, the more cash conversion you had. So you're sort of buying this ASX listed stock, but what you're really buying is a big bucket of cash and then this sort of little piece of AirTrunk. So even had AirTrunk not been sold for the massive premium it was, that would have still been a great trade for us. And then AirTrunk was the icing on the cake. So I would never sit here and pretend we knew exactly how good AirTrunk would be, but we had such a big margin of safety built in when we started in this trade. You don't necessarily need to be able to quantify the upside at that time, you just need to be able to quantify the downside, and we were pretty certain that we had good margin of safety built into that.
So a couple of great examples there of things that have gone really well for you, and as you mentioned at the top, not everything does go well. Do you have, in the interest of balance, maybe something that maybe has done less well?
Yeah, absolutely. I think probably the most high profile trade that we've been involved in, as I said before, not lots of people have heard of Harvest Lane, I don't think, but a lot more people heard about us last year in the latter part, in relation to the ultimately failed takeover of Main Pharma. Main Pharma is an ASX listed company. It's got some US contract manufacturing and also a plant in South Australia. And I mentioned before that a lot of these transactions were really trying to focus on what is the likelihood that this bidder, having said they're going to do something, is now not going to do it. And from time to time, that just happens. And there is very critically in these transaction documents usually something or a section of clauses or conditions called a material adverse change, where it says if the company's earnings is diminished by X amount, or if the net tangible assets is diminished by X amount, that the bidder can walk away. That would happen very infrequently. In this situation, the bidder did try to walk away. They alleged the material adverse change clause. And we never really had a good test case of that in Australia. So there'd been some situations where a bidder had said there'd been a breach of a material adverse change historically, and typically that led to either the bidder just walking away by mutual agreement or a repricing of the deal. In this situation, Main Pharma and their advisor said, we don't agree and we're going to go to court, and we'll have a full hearing about, you put forward your point of view and we'll put forward our point of view, and we'll see what happens. So we had been in that trade, and our view was that it would close, and then the material adverse change clause was alleged. We didn't necessarily agree with that view, but we cut back a lot of exposure just purely for risk management purposes. You asked me before, what do we do when things start to go against us? Even if you don't agree, even if you think the market might be wrong, we're pretty kind of disciplined about cutting exposures. What was really interesting though was, as much for the future value of being involved in this process and understanding how a court would rule and what the flow-on effects of that would be, we stayed really actively involved in the trade, to the point where we went to court every single day, and that was fascinating at various different levels. But one was, it became very, very clear that Main were going to win their court case. Towards the end of it was just absolutely a lay down misere that the judge would rule in favour of Main Pharma, and just anyone could turn up to that court every single day, and we did that. We were able to make some money back on basically our view that the deal would be enforced in Main Pharma's favour. The sting in the tail was that the bidder, who was very clever, had a FIRB condition in the transaction, meaning
so the
that
Foreign Investment Review Board. Absolutely,
yes, Foreign Investment Review Board. I would say generally, nearly always, if you're a US buyer, and especially for a sub-billion dollar asset, the chances of FIRB not giving you approval, assuming that you would like that approval, is very low. This bidder very cleverly represented that perhaps they wouldn't be a good owner of the South Australian asset if they were to ultimately become the owner of it. And there are a few articles online that I had written, and some quotes from me basically saying, the Treasurer should not have been inclined to have to intervene, but he did, and they blocked the transaction. Thankfully, we don't like to take a lot of risk on regulatory outcomes because they're really hard to handicap. So the ACCC, being the Australian Consumer Competition Commission, just because they approved something 4 years ago or 4 months ago, it doesn't mean they would do it now. Similarly with Foreign Investment Review Board, something they were okay with previously, not necessarily okay with now. We probably didn't have a lot of faith in the approval process for further approval to happen, which meant we minimised any further damage. So I guess the wash up of all of that was a losing trade for us. It wasn't we sold and moved on. We stayed very actively involved in the process. We made a little bit of money back as a result of that, but I think more importantly from my perspective was we learned an awful lot about the court process, which we never actually had to go through before. That was the first time that's happened in Australian history. There's a really good precedent now for companies to be able to defend themselves against the allegation of a MAC. So I think that in a lot of the transaction documents that we see for these deals, what a MAC actually is and how it can be measured will be much more clearly defined. I think bidders will be more reluctant to go to court to allege a MAC because they've found that the kind of burden of proof to do just that is difficult. And even on the third point, historically the bidder interacts with the regulators and not the target company. I'm not sure why. It kind of makes sense that both parties would do that, but that's not historically how it worked. We've seen a transaction just this week where now the scheme documentation, the booklet for the transaction, specifically states that both the bidder and the target themselves will interact with any regulators. So from our perspective, that main trade really lifted our profile. It was a losing trade for the fund, but there's been some really good, outcomes post that silver lining, if you will, where we were just really determined to try and extract something positive out of that experience.
That's a great story, Luke. And we won't end on something that's gone wrong for the fund, despite some of the positives out of that. Well, maybe the final question will be more about the broader environment. There's been a lot of talk about the sort of M&A mergers and acquisitions environment not being quite as busy as it has been historically. You'd have thought that your fund would do well with an active environment in that space. What's your view on the outlook for M&A? Some of that might be partly due to the cost of funds being higher and therefore more expensive to take on transactions. Have you seen this pattern, and how would that affect your strategy?
Yeah, it's a great question. I think if you'd asked me 13 years ago or even 7 years ago, my answer would be different. We've done a lot of, back testing, and we've obviously got a big data set around how this works in Australia. It's a question we get a lot. Interestingly, in that small and mid-cap space, economic backdrop, cost of funds, what the kind of indices are doing in Australia and globally, don't tend to have that much of an impact on deal flow. We pretty consistently have, as I said, sort of that 50, I think it's 52 deals a year on average for the last 13 years. I think the high number there has been 62 or 64 deals, the low number's been like 28, but pretty consistently year in, year out, you see sort of the same number of transactions. I think some companies do M&A when markets are booming. Some acquisitions happen when markets have fallen a lot and now they've stabilised and they're kind of bouncing along the bottom. You're seeing a lot of activity in the gold space and base metals to a lesser extent, but gold, because if you are an existing mid-tier producer and you've got sort of assets near to you that are not yet in production, or where the market's not valuing them in the same way that they're valuing you as a producer, you have a natural sort of arbitrage in terms of being able to acquire stuff that's near to you that the market will value more highly when you own it than whatever its current ownership structure is. You tend to probably see more of those wind-up type trades I mentioned, like GDC, when the market's not doing well, in terms of not realising value of underlying assets. So I think definitely, and we saw this sort of 2 or 3 years ago when interest rates sort of started to go up, having been pretty low during COVID and post-COVID, definitely in some of those bigger transactions, you were seeing an impact of not even so much the cost of funds rising. I think it's the uncertainty around cost of funding. So when there's been a big shift in interest rates, trying to find that clearing price where both lender and borrower say, yes, this is the true market rate. I think you need that sort of certainty for deals to happen. Obviously, things like currency affected as well. So, Aussie dollars moved a little bit recently from kind of 65, 66 to 71. Obviously, if you were a US buyer looking at something in Australia, that's now relatively more expensive. So I think there are so many more things that kind of feed into how active our pipeline is, and we're obviously talking to a lot of bankers and lawyers in the transactions we're in, and I will often ask them, how's your pipeline? And we are hearing they have very active full pipelines. And you've seen that in Australia, like you mentioned BlueScope before. We've had Q this week. There's a lot of sort of transactions either happening or rumoured to be happening. Rio and Glencore, it didn't go ahead, but that was in the news 2 weeks ago. So it's sort of our big thing is there are opportunities out there everywhere. What they look like sort of changes as markets ebb and flow, but we've certainly got more than enough pipeline and opportunity as it currently stands.
Great. Luke, that was a fantastic insight into your world. Thank you so much for taking the time to join us today.
Thanks for having me.